Hello, everyone, and welcome back to Last Week on Wall Street, the show where I break down some of the biggest stories from this last week in the world of finance. It has been a hectic few weeks, few months, to be honest. July was a whirlwind. We are now into August, and it is going to be quite the month. It is August 5th today when I'm recording this, and it has been a pretty terrible day in the stock market the last few days, so I will have plenty to talk about next week, but for now, we are going to focus on what happened this last week. Let's dive in. Okay, so this is what we're going to be covering today. We have some more US GDP information. Then we're going to talk about the rotation that we're seeing with investors going into the small cap sector, which differs from what we've seen for quite some time. Then we really can't escape Bill Ackman and Pershing Square. We're going to be talking about what went wrong with their IPO. And finally, some M&A news between Microsoft and Activision Blizzard and their merger being approved. So getting into US GDP, it grew at 2.8% for Q2. This was higher than their expectation of 2.1% and better than Q1, which was only 1.4%. Some of the key drivers include consumer spending and inventories. Consumer spending contributed to 1.6% of that 2.8 rise, and private inventories added 0.82 percentage points. The economy, though, does continue to defy a slowdown. That's because we're seeing continued growth that's beating expectations, but despite all of that, it is still looking positive for some upcoming rate cuts. Treasury Secretary Janet Yellen said that the GDP report was affirming the path we're on to steady growth and declining inflation. She says this mostly because without the inventories, the growth was right at 2%, implying that stable growth metric that the Fed is looking for. And here you can just see the percent change from previous quarters over the last 3 or so years. Other than Q1 of 22 and Q2 of 2022, it has always maintained an increase. Going into the next topic, the small cap sector rotation. This has been a really interesting thing to observe. And this is because positive inflation data is beneficial for the small caps. 30% of small cap borrowings are in floating rate form, which means that there are less interest expenses for those small caps. Why are we seeing people decide to invest in small caps compared to large or mega caps? Well, it's because of the earnings pressure on the high valuations. Tesla and Google parent Alphabet both missed expectations on earnings, and their stocks took a hit. And that's because investors are questioning whether valuations are too high for some of these large cap stocks. And because the valuations might be too high in the large cap stocks, maybe there is better potential elsewhere, hence why people are rotating to small caps. This overall has shown that a lot of money has moved from large caps to the small caps. The Russell 2000 index, which is the accumulation of a lot of small caps, is up nearly 10% in 1 month. Meanwhile, the S&P 500 is down 0.21% for the month. And small cap stocks are still trading significantly below their 2021 highs, which is why a lot of people feel there is potential there. And this makes sense just because you look at the nvidias of the world being worth trillions of dollars, Tesla at a multi-billion dollar valuation. It makes sense to think, how much higher can this possibly go? And especially with everything, all the uncertainty in the market, a lot of investors are taking, or I should say, are closing their positions with those large caps that have been, realistically speaking, very profitable for them. They are taking the win, they are selling their stake there, and they are investing somewhere where they feel there's just a little bit more logical potential, and that is naturally in the small cap stocks. You can see here the data as of July 27th, just how much each of the indexes have changed. It has been very beneficial for the small caps and has been relatively flat to negative for some of the large companies. Now, moving into the Pershing Square IPO, I feel like I can't escape Bill Ackman. I'm constantly talking about him, but it's because he's entertaining to talk about. He, as you know, was raising a fund. They were looking to IPO here in the US, looking to raise $25 billion, but that is going to be a lot more than what they are managing over in Europe. Their fund over in Europe is listed and it manages about $15 billion in assets. But despite that, Ackman is looking to postpone the IPO of Pershing Square due to scaled back expectations for what was anticipated to be one of the largest listings in history. And again, that expectation was his own, but it still stands. The decision to delay the IPO reflects broader market conditions and investor sentiment, which have impacted the feasibility of achieving the desired valuation. With that said, Ackman is now looking to raise $2.5 to $4 billion for the fund, which of course is well below that $25 billion figure that he initially mentioned. And this is a little bit bigger than just Bill Ackman, Pershing Square. I don't think this is truly reflective of him or Pershing Square. I was listening to the All In podcast, and they were talking about it. Just Chamath was saying that hedge funds are such a hard thing to IPO, just because it's hard to really see the equity value, especially what a fund like Bill Ackman's and Pershing Square, where now they have kind of a consolidated view. They are invested in about 10 companies and are holding for the long run, kind of similar to Berkshire Hathaway. So it makes sense. It's a tough space, and of course now is just a tough time to even try to IPO. So I kind of understand why, and I don't anticipate this to be the end of this story. We all know Bill Ackman to be quite persistent with his goals, so I am excited to see where this goes from here. And finally, going into the M&A news, we have the Microsoft and Activision Blizzard merger. The FTC's attempt to block the acquisition between Microsoft and Activision was rejected, which allows the $68 billion deal to proceed. This acquisition is supposed to be one of the largest in tech history, significantly enhancing Microsoft's gaming portfolio by adding popular franchises like Call of Duty and World of Warcraft. The merger is expected to strengthen Microsoft's competitive position against rivals like Sony and Tencent in the global gaming market. This is huge news for the finance world, just because we've seen a lot of M&A deals be rejected by the FTC. Most famously, Adobe and Figma. That was a big one that fell through. And so this is definitely a win. It's good for the business environment. It's good if you yourself are, at a company and you're looking to be acquired. You want that to be able to go through. And it's good for investment banking fees. It's good for a lot of things. And I think the FTC initially was hesitant with this just because Microsoft owns the Xbox and they weren't sure how acquiring a video game company would affect that. It makes sense just because if you think, okay, if they made it so that you could only play Call of Duty or World of Warcraft on Xboxes, that seems a little bit unfair. My perspective on this is that's the world we live in. The world is unfair, but I also understand that because it just could create some conflicts of interest there. I think they got to the bottom of this by allowing or by forcing Activision to still host the game on other platforms as well. So that was some big news. I'm excited to see what other M&A news transpires in the coming weeks. But that's going to wrap up the video. I hope you enjoyed watching. Brace yourself because this is going to be a big week, and I'll see you in the next video. Peace.